Okay. Good evening, everybody. Welcome to tonight's webinar series from AB Capital Securities Incorporated. Tonight we are discussing Financial Analysis 101. Okay, and we have lots to cover for the evening. In fact, even before we started, we already have a number of questions coming in from our attendees, and we encourage everybody throughout the evening. If you do have any questions, anything you'd like us to discuss at any given time, you can type in your questions in the question window, and we'll get to that as soon as we can. Now, in the meantime, just to give you an idea of what's going on tonight. Like we said, this is part of an ongoing series of financial talks by AB Capital Securities Incorporated, and pretty much we have for the evening our expert speaker, Mr. Gregg Ilag, and he is the equity analyst of AB Capital Securities Incorporated. To give you a little more about of what he's about, he's actually a sell-side equity analyst, and he covers utilities, conglomerates, and property companies in the Philippines. Now, Greg has a lot of experience when it comes to writing equity research reports, and that includes mostly analysis on certain companies, financial analysis, industry analysis, and even financial models and valuation. So Mr. Ilag also passed the CFA Level 1 examination, so that's pretty cool. All right, so tonight our webinar is brought to us by AB Capital Securities Incorporated, which is one of the Philippines' leading financial services institutions focused on the capital markets. AB Capital, an investment corporation, is an investment house that has built its capability on three major areas of strength, which is corporate finance, fixed income securities dealership, and fund management. Okay, my name is Renzi Baluyot, and I am your moderator for the evening, and I will be here to assist you with your questions and your anything you'd like to raise and ask our way. But in the meantime, I'd like to give you our speaker for the evening. Ladies and gentlemen, here's Mr. Gregg Ilag. Hello, Greg.
So,
how are you doing?
Hello. Yes, I'm doing great. Yeah.
Hi, Greg. All right. So, okay. So, just so we address the questions from earlier today, we've had some of our attendees were already asking, what are we covering for tonight, and will they be having copies of our presentation emailed to them? Yes, please. Go ahead. Go ahead, Greg.
So for tonight, we'll be discussing the basic concepts of financial analysis. And we'll start by covering the basic financial statements, their forms, and then we will delve deeper into each statement as we go through the webinar. We'll be emailing the copies of the presentation to the participants who finish the webinar.
Okay. All right. Okay. So we just want to make sure that everybody can see the presentation on screen. Once again, if for some reason you are encountering some technical difficulties, do let us know. We have a team on standby to assist you. And again, if you have questions, there is a questions window where you can type in your questions and direct it to us, and we'll be able to answer your questions as we go along. Okay? And there's a more in-depth Q&A at the end of the talk. Of course, Greg will take care of that. So once again, ladies and gentlemen, here's Greg.
Okay. So good evening, everyone. I'm here to present to you the financial analysis for equities, or primarily for stock market investors. So we hope to impart to you the basic concepts involved whenever you undergo financial analysis. So to start things off, we will give you first the most basic definitions of financial analysis. So the first definition would be to financial analysis is that you have to understand a business based on its financial statements. So So when it comes to a financial analysis, you're dealing mostly with financial statements, and you use these to understand the performance of a firm over a certain period of time. And then you'd want to do this because stock market returns or returns within the stocks you invest in is usually influenced by the performance in terms of financials. And then as we go along, we will first look into the three types of financial statements, which is the income statement, the balance sheet, and the cash flow statement. And then once we get an overview of these three statements, we will move on into a more deeper understanding of each. First is the income statement, in which we will see the revenue mix, the profit margins, the profit mix, as well as the segment margins. This is basically a measure of the profitability of the individual segments and the profitability of the firm itself. And then after the income statement, we will move on to the balance sheet, which shows you the composition of the firm's assets, the breakdown of its liabilities, and the breakdown of its own shareholders' capital. We will look into the individual accounts of these balance sheet statements and then use these accounts to determine solvency and liquidity ratios and also find efficiency ratios using those accounts. And then we will move further to the final financial statement, which is the cash flow statement. In the cash flow statement, you will see the sources and uses of cash flows, which is denoted by the positive and negative cash flow signs. Then we will focus on the most important line item in the cash flow statement, which is the operating cash flow. This is a line item that is readily obvious in the statement. And then we will try to measure free cash flow, which is the most important measure that investors try to estimate from the cash flow statement. Now, free cash flows are not usually stated in the financial statement, so you'd have to derive it on your own. And then for the last part, we will look into the shareholder returns, which are a measure of returns that you earn whenever you buy equities, and the measure of returns that the company earns when they invest into the assets. Okay, so now we start with the income statement. So the income statement shows you the revenues and profits for a certain period or a certain year. So you can see here the obvious line items, such as the sales of goods and services, cost of sales, gross profits, selling and distribution costs, general and administrative expenses, and operating income. So usually income statements go as low as net income, and they also include the non-cash costs such as depreciation and amortization. So, and we will also include these later, but for now we will just show you the operating income. So all these statements shown in these slides are from URC's 2012 fiscal statement. So after the income statement, we will show you the balance sheet, which shows the company's assets, liabilities, and equities. So you see here that that URC has several accounts in its current assets, such as cash, financial assets at fair value, available for sale investments, inventories, biological assets, and other current assets. Now, besides these assets, URC also has non-current assets such as property, plant, and equipment, and intangible assets. Now, balance sheet would also try to show you the liabilities of a company, those which are mature within the next 12 months, and those which mature for more than a year. And we classify those as current and non-current liabilities. Then you'd also see equity, which is the shareholders' claim to the company's assets. So we will also show you liabilities and equity in the later slides. So for now, we will just stick first with the current assets. And then for the cash flow statement, we will be showing you the sources and uses of cash.
Oh,
Hello?
Greg, excuse me. We have a question coming in
Yes.
from one of our attendees. A question came in. What are biological assets?
Oh, biological assets are the assets that somehow have what do you call it? They're usually animals or poultry
Okay, look like
types of
livestock or
animals.
mhm.
Livestock, yes. Those kinds of assets. They're usually accounted for more than 12 months, depending on the life of that certain poultry or pork
So
or
would that
farms.
include mga crops or mga crops or like if you have a tree farm or something, would that include yung mga plants and essentially plants and animals? Tama ba?
It's usually animals.
Mostly, okay,
Companies,
usually animals.
yes. Biological assets are usually found in companies that engage themselves in food manufacturing,
That's right.
and
Okay.
those are usually their input to produce certain products that are related to
Mm,
meat or chicken.
okay. All right. So I hope that question came in from Miss Rita. So I hope that that pretty much satisfies that. Thanks, Rita. Okay.
Okay. And then, as I've said, the cash flow statement shows you the sources and uses of cash. And then it will also show you the conversion of the income statement line items towards a better measure of cash. So here you could see that income before income tax is converted into cash using the adjustments from depreciation, market valuation, finance revenue, and finance costs. We will show you a more detailed conversion later. Okay, so now we go back to the income statement and to a more deeper understanding of this statement. So we start with the individual line items that make up the income statement. So investors typically look at sales or revenues, then operating income, then net income. So whenever you look at the income statement, it is obviously spelled out where the sales is. So for URC, sales is represented of goods and services, which shows a balance of 57 billion in 2010, 67 billion in 2011, and 71 billion in 2012. So normally you'd want to see an increasing number in sales. Then after sales, companies usually report the input costs related to producing revenues. So in this case, the cost of sales is reported next to sales of goods and services. Then after you deduct cost of sales, you would arrive at the gross profits. So again, you'd want to see an increasing number in gross profits, and then you'd want that to grow faster than sales. So that usually happens when cost of sales grows slower than your actual revenues. Now, investors do not really put much attention to gross profits since there are other costs related to producing revenues, such as selling and distribution and general and administrative expenses. So here we focus more on operating income, which is 7.6 billion in 2010, 6.8 billion in 2011, and 7.8 billion in 2012. So operating income is a broad measure for the profits when you only deduct operating costs. And then the final line item that investors usually look at is net income. And then you see here that URC made 8.1 billion in net income in 2010, then 5 billion in 2011, and 8.1 billion in 2012. So just to recap some definitions, sales is the amount of products sold by the firm. So typically, the formula for sales would go to price multiplied by quantity. And then operating profits is the profits left after deducting operating costs. So in business, there are two types of costs. We call it non-operating and operating cost. And then sometimes non-operating costs are just expenses that is accrued by accountants. And then here we have net profits, which is the actual profit left after you deduct all kinds of costs related to your business. So after looking into the consolidated revenues, you'd want to see which segments of your company or which segment of the stocks you're looking into drives the revenues of that firm. So you can see that by looking into these notes to the financial statements. And then these notes are usually called operating segments or segment information. Okay, so if you look into URC's notes to the financial statements, you can see here that URC has three main segments, namely the branded consumer food, the agro-industrial segment, and the commodity foods segment. And you see here that branded consumer foods made 61 billion in sales for the year 2012, while agro-industrial made 10 billion in sales for the same year, and commodity foods made 11.85 billion during the same year. So there is also a line item here called the inter-segment, which represents the sales from one segment to another. So companies usually exclude that whenever they report the overall sales of their companies, since these only represent sales within each segment. So you'd want to represent sales that are to other people or to your external clients. And then to get a better understanding of this table, you'd want to convert it into a chart. So this is what we do here. You can see here that we turned the data into a chart in which you would see that the branded consumer food group contributes 73% of total sales, while the agro-industrial food group and the commodity food group only makes up 27% of URC's total sales. So it's still not enough if you just look at 1 year for financial analysis. You need to look at a certain number of years or compare these figures to other firms in the industry to come up with some conclusions. So for this example, we plot here the sales of all three segments for the past 7 years. And you could see that the branded consumer food group always contributes the biggest portion of revenues. But from what we can deduce here, you could see that the branded consumer food group's share in total revenues has actually declined. And agro-industrial and commodity food groups is now able to contribute more revenues for the past 7 years. So in financial analysis, you'd want to look at the historical perspective to come up with some conclusions regarding the firm. And you'd want to know whether those changes are favorable for the firm or not. Okay, so after looking into sales, you'd want to look into margins. So margins is a conversion of the individual profit line item towards a more understandable number. So the general formula for margins is profit over sales. So whenever you look at an income statement, there are three main types of profits that you would immediately see. These are the gross profits, operating profits, and net profits. You'd want to convert these line items of profit into margins to get a better understanding of these. So first, for the gross profit margin, you just take the gross profits and divide it by sales. And then for the operating margin, you take the operating profit and divide it by sales. And you'd also take the net profits and divide it by sales to arrive at the net profit margin. So we apply these margins to the financial statement that we have shown you a while ago. So for this example, you see here that URC made 18.47 billion in gross profits for the year 2012. And you divide that amount by the sales of 71.2 billion, and you get 25.93%. That means that 25.93% of sales is left after you deduct input costs related to producing goods and services. Then you apply the same example. You take the 7.8 billion in operating income and divide it by the 71.2 billion in sales to arrive at the operating profit margin. So here you'd see that the operating profit margin is 10.95%. This means that the 10.95% of sales is left after you deduct all costs related to the operations of the firm. And finally, for the net profit margin, you take the line item of 8.16 billion and divide it by the 71.2 billion to arrive at the 11.46% net profit margin. So this means that the firm earns around 11% of everything that it sells as revenues. So to be able to conclude again anything on these profit margins, you need to look at it from a historical perspective or compare it to other firms in the industry. So in this case, we look at URC's gross profit margins from 2006 to 2012. And then there are two conclusions that you can derive from this. The first conclusion is that URC has not been able to continually expand its gross profit margins consistently since it depends a lot on commodity prices abroad. And then the other conclusion that you could make of this is that the gross profits margin has a lot of space to improve on towards 34% since it went as high as that during 2010.
Greg, we have a question from one of our attendees. I suppose right now, because we're looking at like a big company like this now. Now, Erwin's asking, and maybe you can help us out here. What is the acceptable net profit margin for a good company? Meaning, would this change for, say, an SME or something like a larger food conglomerate like this? So, what would normally be acceptable net profit margins?
The word acceptable would probably vary across industries. For example, for utilities, they usually report 30% net profit margins. For food manufacturing firms, 11% is already good enough. For telecoms, they have fewer margins, less than 10%. So it varies depending on the industry.
According to industry.
So yes. In my experience, since I cover utilities and food manufacturing firms, around 10% for food manufacturing firms and 30% for utilities. Except if you're Meralco, since Meralco has a lot of passed-on costs.
Okay. Now, does this vary from country to country, or is this regional, or more or less across the board?
Yes, it also varies per country, since different countries usually adopt different accounting for expenses, and that would easily affect your net profit margins on a year-to-year basis.
Okay.
So some regions like to employ one-time costing, or some would prefer you to spread it over a number of years. So sometimes it's not good to compare it across the region.
Okay, thanks for that. Sige.
Okay, thank you for the question. Okay, after looking into the gross profit margins of URC, we would like to see the breakdown of its profits. So essentially, you'd want to look at how much each segment contributes to the consolidated profit of a firm. So here we highlight two key line items: the earnings before interest and income taxes and depreciation and amortization, and the earnings before interest and income tax. So the EBIT, or the earnings before interest and income tax, is also the operating income, which we showed you a while ago. So you see here that the branded consumer foods also makes up the majority of the operating income. So it gave out 5.5 billion in operating income for the year 2012, while agri-industrial contributed 359 million in the same year, and commodity food made 2.8 billion during that year too. And then if you turn this data again into a chart, you see that the commodity food group now contributes 32% of operating profits, while it only contributed 14% of revenues. And you could attribute that to the fact that the commodity food groups have a higher operating profit margin compared to the branded consumer food group and agro-industrial foods.
Now, Greg, another question just came in, and I suppose it's fairly interesting. So, where do you normally get these figures? Um, uh, are they part of, like, I don't know, annual reports or something, or how do you normally when a company, how do these figures normally come about?
These are usually presented in the financial statements, in the
Okay.
notes to financial statements. So you could easily see this by in the PDF. You could just type Control F and then type their segment information or operating segment, and then it will easily just prompt you to the part of that PDF.
Okay.
And these usually appear on the either on the very early part of the note or at the very latter part. So there's a number there, usually number 4, number 29. But then it also varies on the companies, and not a lot of companies disclose this. But in URC's case, they have a lot of disclosures, so you can readily see the profits of each segments.
Okay. All right. Thank you.
Okay, and then as we said, the operating profit margins of the commodity food group is much higher than the branded consumer food group and the agro-industrial group. So we plotted the margins here, and you see that the commodity food group has around 24% in operating profit margin, while the branded consumer food group has around 9% in operating margin, and the agro-industrial has less than 5% in profit margin. So again, to come up with some conclusions, you need to look at margins from a historical perspective. Okay, so we plotted all three margins here. So for us not to get confused, the commodity food group is plotted on the right side, and the branded consumer food group and the agro-industrial group is plotted on the left side. So first, we take the commodity food group. The commodity food group is the green line, which has a margin of 30% in the year 2005. And you see that the margin has actually declined towards 25% in 2012. Okay, so next you would look at the agro-industrial group. It has 12% in operating profit margins in the year 2005, and has less than 4% in operating profit margins for the year 2012. So the agro-industrial group is the red line. Now the most significant improvement that we can see here is from the branded consumer food group. You see that they have a 4% operating profit margin in 2006, and they have been able to double that margin for the past 6 years towards 9% in 2012. So this would bode well for URC, since the branded consumer food group also contributes the majority of revenues of that firm. So you'd want to also look that up. You'd also want to conclude that whenever you're doing financial analysis, you'd want to see which segment has consistently improved its operating margins, and whether that segment is the biggest contributor to the consolidated revenues. So we also placed here the things that we would like to see whenever we do financial analysis of the income statement. So you'd want to see growing sales and profits, and if you can, the growth of sales and profits going forward. Then you'd also want to see improvements in the operating profit margins or net profit margins of the firms you're analyzing. And you'd want to see growth from revenues, especially from the segments that have the higher profitability compared to other segments, since that could lead to improvements in the margins of the firm. So after finishing the income statement, we proceed to the balance sheet. So the balance sheet is a less important financial statement when you're an equity investor. However, you'd also still need to look at this since problems on the balance sheet of firms could easily influence sentiment over a stock. So the balance sheet usually shows you the composition of assets, liabilities, and equity. Then you could use the line items of these accounts to measure solvency and liquidity ratios, which measures the debt levels of a firm and whether those debt levels are still favorable going forward. Then you could also measure the efficiency of the firm, which shows you if the assets of the firm is being managed carefully. Okay, so we start with an example of the balance sheet of URC. You see here that the main divisions of assets are current assets and non-current assets. And for the current assets, you have here cash, financial assets, available for sale investments, receivables, inventories, biological assets, and other current assets. And then for the non-current assets, you could easily see property, plant, and equipment, intangible assets, biological assets, and other non-current assets. Now, the difference between a current asset and a non-current asset is that you could easily convert a current asset into cash within the next 12 months, while the non-current assets usually take more than a year or even 2 or 3 years before you could actually turn these into cash. So normally you'd want to see a modest amount of money both in current assets and non-current assets. So if current assets are too low, the company would easily run out of cash in its day-to-day operations. And if the non-current assets are too low, then the company basically does not have enough investments to expand its operations. So in this case, investors usually look into cash, receivables, and inventories. And then in assessing these accounts, you need to turn them into efficiency ratios to come up with some meaningful conclusions. And we have here some...
Greg, we have another question here. Now, if I may, now, I think a question came from one of our attendees. Too low compared to what?
Oh, you'd want to see if it's too low compared to the total. You see here, for example, you see here that URC's current assets is 39 billion and the total non-current assets is 30 billion. It's evenly placed between current and non-current. So you'd want to see that kind of sharing since, for example, if 90% of the assets are current assets, then that means that the company is no longer investing in fixed assets, which help you expand your operations. That helps you grow your revenues.
As a follow-up, now, is there a ratio for current and non-current assets? Like, should it be, I don't know, 50-50, or how's it normally? How do you normally gauge that?
There's not really a rule of thumb.
Okay.
But you'd be easily able to interpret their plans just by looking at the composition, and then you can tailor which stocks would you invest in. That, for example, if a certain stock has too much cash, but it doesn't declare dividends, then it usually doesn't perform. So they usually indicate the plans of management. So it's not necessarily that bad, but it gives you an idea on how the company is going to perform going forward.
Okay, another follow-up question here. Are the figures here in the balance sheet marked to market value or at cost acquisition figure?
That depends on the assets. Some assets, such as the financial assets and available for sale investments, are marked to market. And then some are marked at cost, such as property, plant, equipment, intangible assets, biological assets. The accounting treatment actually differs for each line item.
Okay. All right. I think we actually had like a whole bunch of questions from our attendees, which is good, and we really encourage you guys to send in your questions so we can take them on as they come in. So thanks, guys. And all right, go ahead, Greg. Please proceed. Thank you.
Okay. And okay, so first we define the most widely looked at company accounts. First is the receivables. This represents the amount owed to the company by its customers. So usually companies have a clientele which buy on credit, and then since they cannot immediately put up cash to pay down on whatever it is they bought, so it is reasonable for companies to extend credit whenever they sell their products. And then for inventories, again, this is very self-explanatory. This is the assets used to be sold, or the assets used to produce your revenues. So the level of receivables and inventories are assessed using efficiency ratios, which we will tackle later on. Okay, so this time we will look at liabilities on the balance sheet. So we have here current and non-current liabilities. So the main difference between the two is that the current liabilities are to be paid within the next 12 months, while the non-current liabilities are to be paid after a year or more than 2 years. So this means that all the amounts in the current liabilities portion are actually paid down by URC by September 2013. So for this part, investors usually look into accounts payable, short-term debt, and long-term debt. So just some brief explanations. The accounts payable represents the amount owed to your suppliers. So URC usually borrows first some money to its suppliers before actually paying them down, because they need their own money for their own working capital. Then we have here long-term debt, which is the amount owed by a firm to another corporation. This represents how much debt you owe basically to another firm. Then the current portion of long-term debt is the maturing portion of that debt, which you need to pay within the next 12 months. These are very straightforward accounts that is used in accounting, and then these accounts are what is usually looked at by ordinary investors. And then for the last part of the balance sheet, we have here the shareholders' equity. So for the shareholders' equity, you need to focus on retained earnings and the total amount of equity, which is the claim of investors to the assets of the company. So companies with little or no total equity signify indebtedness, and you'd want to stay away from those kinds of investments. So again, we will explain some definitions. Retained earnings are those profits of a company that are not paid out as dividends and are retained in the business. So whenever a company earns money, they have the choice whether they would like to expand to other places or to other countries, or they could just pay out that money as dividends. And then dividends is the distribution of earnings to us investors. So as an investor, you have two sources of returns whenever you invest in the stock market. So the first source of return is price appreciation, in which higher prices give you returns. And then the other source of return is dividends. So you can see here that URC declared 3.9 billion in dividends for the years 2011 and 2012, and that amounts to 1.90 pesos per share. So the company usually retains 50% of its net income from the preceding year. So that means that they pay half of the 7 billion net income in 2011, or rather 7.8. So after looking into the individual line items, you'd use these line items to measure some ratios. So the first ratios that we measure would be solvency and liquidity ratios. So liquidity measures the ability of the firm to meet short-term obligations, or obligations that are set to mature within the next 12 months. And then solvency measures the ability to meet long-term obligations or those debt that would last for more than a year. So the most prominently used liquidity ratios is the current ratio, quick ratio, and cash ratio. As for the formulas, this is a very straightforward formula. You just take current assets divided by current liabilities to measure current ratio. Then you'd look for a more stringent measure using cash plus receivables divided by current liabilities to measure the quick ratio, and then you'd use cash divided by current liabilities to measure cash ratio.
Greg, I think a question from another attendee just came in, and Carlos was asking, now what about the earnings for the owners of a company, or the company itself? Now, how do you determine actual earnings from a company after all these?
The actual earnings of the company is the net income.
Okay.
But if you want a more stringent or a more complex measure, I think you'd have to remove non-recurring cost, and then you'd get something called a recurring income. So recurring income is usually what do you call this? It's usually one of the measures that differs across investors. So some investors like to take out certain items, and some investors like to include certain items. In URC's case, there's not a lot of non-recurring costs, as you can see in this slide. The net income of 8.1 billion only has a few expenses that are non-recurring, such as impairment losses and other expenses. So companies with a lot of with very few non-operating costs usually report high quality in earnings, or rather high level of recurring earnings, which is, I think, the best measure of how much a company is earning.
All right. Okay.
Okay. Sorry.
Thank you, Greg.
Okay. So we also have here the solvency ratio, which shows you the ability to meet long-term obligations. So the most prominently used solvency ratios is the debt ratio, debt to equity ratio, and the interest coverage ratio. So you take total liabilities and divide it by total assets to arrive at the debt ratio. You'd also try to use total liabilities divided by total equity to measure the debt to equity ratio. And then the interest coverage is just operating profit divided by interest expenses. So again, we apply these examples to the balance sheet of URC. So you take the 39 billion in current assets, as shown here, and divide it by the 20 billion in the liabilities section. So you just basically just divided 39 billion divided by 20 billion, and you get a ratio of 1.95 times. So 1.95 times, or rather 2 times, represents how many times that the company's current assets can cover the liabilities that will mature in the next 12 months. Then for the quick ratio, it's again just the same example. You take the 5.3 billion in cash, and you add to that 7.4 billion in receivables, and you come up with a ratio of 0.64 times. So that represents 64% of the current liabilities that can be paid out with just the cash and the receivables. Then you'd also do the same for cash ratio. Just take the 5.3 billion and divide it by 20 billion, and you come up with a measure of 0.27 times, which means that the cash can pay down 27% of the current liabilities. And then for solvency, you just again take the debt ratio, which is just the total liabilities divided by the total assets, which are shown in the balance sheet. Just 23 billion divided by 69 billion then you arrive at a number of 33%, which means that 33% of the assets are funded using debt. And then the last solvency ratio that we will tackle will be debt to equity, which is total liabilities over total equity. In this case, it is 23 billion divided by 46 billion, and you derive at a figure of 0.5 times. So as an equity investor, you'd like to see increasing liquidity ratios and decreasing solvency ratios, or liquidity ratios that are better than the industry average.
Okay. Now Carlos has another question, and he's asking, for all these ratios, normally do we look at certain guidelines when we look at these? So how do we know if a company is healthy? What do you normally look at here? Pagka ganyan.
There's a rule of thumb that the current ratio must be greater than 1. And
the
there's
current
no
ratio
rule of thumb.
must be greater than 1. Okay.
1, yes. And then the quick and cash ratio, there's not really a rule of thumb on that.
Okay.
For the debt to equity, it must be less than 1. And then for the debt ratio, there's no rule actually. So yeah, those are quick ways to assess these ratios.
Okay. So Carlos, I hope that answered your question. Thanks for asking. Now another one just came in from Anthony, and he's asking, should one be worried if a bank's current ratio is below 1? I think he's pretty specific here. He's asking, specifically a bank. The current ratio is below 1.
For a bank? Sorry, for...
Yeah. Should
banks
one
have
be
a lot
worried?
of... banks have a different structure altogether. So they usually have more leverage, and most of their liabilities are just deposit claims. So I don't think you have to be worried. There's a certain level of capital adequacy ratios that are used, and those are a bit more complicated.
Okay, so for banks, this is really a totally different parang a different set of guidelines for this.
Yeah.
Okay.
And then
so
since their debt structure
at which point should you be worried then? If it's not just below 1, I mean, what's the point that you normally have to be worried if it's a bank?
There's no really rule of thumb for banks. So I think you just want them to comply with the level of capital adequacy mandated by the Banco Central. So those are easily published in the newspapers.
All right.
You could easily see which banks follow those.
Okay. Well, Anthony, I hope that answered your question. Thanks so much for asking.
Okay. Okay, so we show here that URC's liquidity ratio has stayed fairly constant from 2008 to 2012. And there's no need to worry ourselves of this current ratio since it has stayed fairly stable above 1. And on the other hand, URC has been able to continuously decrease the levels of its debt from 45% debt ratio. It's now just 35%, and the debt to equity is already less than 0.5. So now we arrive at the last part of the analysis in balance sheets, which is the efficiency ratios. Now, efficiency ratios measure how well the firm manages assets and liabilities. So there are 4 prominently used efficiency ratios, and this is the receivable turnover, inventory turnover, payable turnover, and fixed asset turnover. So the receivable turnover measures how well a company manages its receivables, and then the inventory turnover shows you how efficiently inventories are being managed. The same thing goes for payable turnover and fixed asset turnover. The formula for turnovers are very straightforward as well. You see here that the receivable turnover is just sales over receivables. The inventory turnover is just cost of sales divided by inventory. And And then the payable turnover is credit purchases over payables. Now, sometimes the credit purchases are not disclosed by firms, so you can just take in the operating expenses and divide it by the payables to come up with a proxy for a payable turnover. So we apply again these turnover equations to the example a while ago. We have here 71.2 billion in sales, and we divide that by the 7.46 billion, and we get a ratio of 9.45 times. And then we do the same for inventories. You get the 52.73 billion cost of sales and divide it by the 9.7 billion inventory to arrive at a turnover ratio of 5.44. Now, a better way to interpret these ratios is to use them as a divisor by the number of days in a year. So, for example, if you use the 9.45 times as a divisor to 365, you get a number of 38 days. So that means that it takes 38 days to convert a receivable to cash. And then the same thing goes for inventories. If you use the 5.44 times as a divisor to 365 days, you come up with a number of 67, which means it takes 67 days to convert your inventory into cash. So some firms judge turnover levels as bad or good, whether they are high enough or low enough to their benchmark standards. So in our case, we would judge this by comparing it to the industry average. So turnovers that are far from the industry average is not usually a good sign. So URC has lower turnovers compared to the regional peer average. It only has 9.45 times receivable turnover compared to peer average 10.32 times and 5.44 times inventory turnover versus peer average of 6.73 times. So this basically means that URC takes longer days to convert its cash, or rather to convert sales into cash compared to its peers. So, but this is not necessarily bad since the turnovers are still near the industry average.
Now, Greg, a question just came in from Marlo, and he's asking, how can we know the industry's turnover average?
There are some websites that publish the peer average ratios. You can go to fortraders.com or reuters.com, and then you just type the company name, and then the search engine will automatically work.
So they normally have this online, okay?
Yes, they normally have this online. However, the data there is not usually updated, and I think it's just once a year updated. I'm not really familiar with how many times they update it.
And this is like a
But
worldwide...
I think for traders,
okay.
yes, this is worldwide. I think for traders is more updated. It's connected to Bloomberg, I think.
All right.
And
so Marla, I hope that that helps. Yeah.
They also show their consensus estimates if you're interested in that.
Okay. All right.
Okay. So
Thank you.
Now we
Thanks for asking, Marla. All right.
Okay. And then we proceed to the third financial statement, which is the cash flow statement. So cash flow statement shows you again the sources and uses of cash. So there are very few line items here that you could actually use. Okay, so we would focus on the most basic cash flows, which is operating cash flows and free cash flows. So free cash flow is not really that basic, but it is one of the most important measures used in financial analysis. Okay, so first is the operating cash flows. So operating cash flows are found as a line item in the cash flow statement, usually provided for by the accounting firm. You can see here that the operating cash flows of URC is 8.7 billion in 2010, 8.9 billion in 2011, and 12.98 billion in 2012. Now, operating cash flows are, as I said, are spelled out, and there are two other types of cash flow, such as investing cash flow and financing cash flows. but then for simplicity, we will just focus on operating cash flow. So as an investor, you'd want to see an increasing level of operating cash flows since they precede dividend payments to investors and investments in fixed assets, which could be used to expand the operations of the firm. Now, operating cash flows can also be used to acquire other companies and to pay down debt that is due by the firm. Now, companies that have net losses with positive operating cash flows can invest in assets to improve their profitability. So companies with a net loss but positive cash flows usually have high non-cash costs such as depreciation and interest expenses. Now, normally we'll still view these companies as positive since they can reinvest to improve their profitability going forward. And rapid improvements in profitability usually support stock price performance. So here we plot URC's operating cash flow. You can see here that URC made around 6 billion in operating cash flows in 2008 and 2009, and around 9 billion in operating cash flows in 2010 and 2011, and around 13 billion in 2012. So URC looks favorable from the operating cash flow standpoint. And then the next measure we'd like to look at is the free cash flow or operating cash flow less capital expenditures. Now, capital expenditures are not spelled out bluntly in financial statements. So usually they are included in the property, plant, and equipment account. So in this case, we think that the best measure for capital expenditure is the change in property, plant, and equipment, as shown in the cash flow from investing part of the cash flow statement. So you just take the 12 billion in operating cash flows and deduct 5.1 billion change in property, plant, and equipment.
Now,
So
Greg, I'm sorry. Let me just cut you right there. I'm sorry. Question came in from RC, and her question was about the company turnover. The question goes: if a company turnover is below the industry, at what level should we be worried, and at what level can we accept as investors as compared to the industry's ratio?
again, there's not really a rule of thumb when it comes to turnovers. But I think if the turnover of your firm, for example, is about half of the average, for example, in this case, if the peer average is 10 and the turnover of the firm is less than 5, then you'd want to be concerned since the conversion into cash is too long. Okay, so I think that's a good benchmark for if it doesn't really hit around 5 or around half of the average.
For investors naman, what's an acceptable level usually pag ganyan?
For turnovers, there's also no rule of thumb on that. Usually, investors do not really pay too much attention on turnovers as well, except if you're a food manufacturing firm or a retailing firm like Pure Gold. Investors usually just look at profits usually. So I think that's why there's not really a level of rule of thumb for turnovers.
Okay. All right, RC, we hope that answered your question. Thanks so much for asking. All right, Greg, thank you.
Okay. Okay, so going back to the example, you take the operating cash flow of 12.98 billion and deduct their 5.13 billion and arrive at a conclusion of 7.85 billion. So you'd want to see increasing levels of free cash flow, since higher free cash flows will indicate that the firm can raise dividend payments in the future, and higher dividend payments will ultimately enhance your return as an investor. So for free cash flow, you can see here that URC's free cash flow has grown significantly from 2011 to 2012, and we attribute this to the robust growth in net income from 2011 to 2012. So the last portion of the financial analysis that we prepared is the measure of returns. So we will focus on the two basic type of return measures, which is return on equity and return on assets. So return on equity measures the investor's return whenever they buy a stock, and the return on asset measures the return of the company when they invest into their assets. So the formula is net income over total equity for return on equity, and net income over total assets for return on assets. So we would want to see also increasing numbers from these returns.
Okay, Greg, a question came in. This is from Marlon. He's asking, why is it that the figure of free cash flow in AB Cap's website had a different figure for URC?
I think the measure in AB Capital's website was from a TechniStock, and TechniStock may be using a different measure for capital expenditure. And I think that's why there's a difference. I'm measuring capital expenditure through changes in property, plant, and equipment, and I'm not really familiar with what TechniStock is using as a measure for capital expenditures.
Okay.
And as I've said, the free cash flow is an estimate, so estimates sometimes would vary between people.
All right. Marlo, I hope that answered your question. So again, if you have any questions, just feel free to just field them in. All right. Thanks, Marlo. Greg, back to you. Thank you.
Okay. So for the return on equity, it's just net income divided by total equity. So you take the 8.16 billion in net income and divide it by the 46.6 billion in equity, and you come up with a measure of 17.5%. And for the return on assets, you take the net income of 8.16 billion and the total assets of 69.98 billion, and you arrive at an answer of 11.6%. So that means that it takes you around 67 years to earn all the assets and around 6 years to earn your equity investment.
Okay. Now, Greg, another question just came in. This one from Carlos, and he's asking, what are the sources of equities?
Sources.
Can
you be more specific?
If you can be a little bit more specific, Carlos, now we'll be able to take on that question in a bit. So it's okay. While we're waiting for Carlos's response, let's turn it over back to you, Greg.
Okay. So here we have URC's ROE from 2008 to 2012, and you can see that ROE has steadily increased from 11% in 2008 towards 16% in 2012. And you can see here that the return on assets of URC has significantly increased from less than 2% in 2008 to more than 10% by 2012. Okay, so we would like to summarize the key points that we have pointed out in this presentation. So in financial analysis, you'd like to see potential growth in sales and profits, and you'd want to see improvements in profit margins driven by individual segments with higher profits. You'd want to see decreasing levels of debt and improving levels of liquidity, and you'd also want to see turnovers that are near the industry average, as well as higher ROE and free cash flows. So I could take in questions from here on.
Okay. Now, getting back now to Carlos from earlier, he's asking, are these preferred shares or IPOs or money invested, owner's money, not by common stocks? So yun ang kanyang follow-up.
Sorry, can you repeat that?
His original question was, what are the sources of equities? Are these preferred shares or IPOs?
Oh, equity means basically equity means investment of a person or a firm. So it basically means ownership. So preferred shares, IPOs are actually transactions derived from ownership of a firm. So in basic essence, equity means ownership,
Okay.
and then preferred shares are a type of equity, and then IPOs are a chance for the public to get ownership in a firm. So sources of equities are just the ordinary person or other corporations that wish to invest in your company or to have an ownership in your company.
All right. So Carlos, I hope that answered your question. Um, and if not, just go ahead and send us follow-up questions. And so Greg, are we opening the floor to more questions?
Yes, I
Okay.
yes the
All right. No,
questions.
so all right. So we'll be taking in more of your questions, and we see a few more coming in. Now, in the meantime, I just want to put this out there. So this evening is all made possible also by our friends over at eLearning Edge, and they have this Certified Digital Marketer CDM program by the International Institute of Digital Marketing. It's a professional certification course designed for on-the-go marketers and businessmen, built on both managerial and technical points of view. So it's a full online course. Students like ourselves can choose to learn anytime, anywhere, um, anywhere they may be, in fact, at their own preferred pace. So you can have face-to-face, well, these are optional, face-to-face introductory sessions for each module of the program. And it's available to students who would like to get a helicopter view of the subject and interact with the featured subject matter expert. We have lots of those guys. So it's the Certified Digital Marketer Program. It's recognized and supported by Ateneo de Manila University and De La Salle University, as well as the Ateneo Java Wireless Competency Center and the Global and Local Advisory Board members. So if you want to know more about this, you can get in touch with the guys over at eLearning Edge. For more details on the CDM program, you can get in touch with them by checking out the website at imadigitalmarketer.com. That's imadigitalmarketer.com. And the phone number is right there. It's 927-0096. Okay. So back to more of our questions here. This one coming in from Daniel. He says that I usually read about PE ratio of a company. So what is a PE ratio, Greg?
PE ratio is price to earnings ratio. It's actually tackled more in a valuation topic, but since it's asked right now, a PE ratio measures how much you pay relative to how much the company earns. So it's price over earnings per share. So PE ratios is the most basic measure of price in financial markets or in stock markets. So
Okay.
PE is a standard in which we try to see whether a stock is expensive or not. So a PE above 16 is usually viewed as expensive, and a PE below 16 is usually considered cheap.
Okay. So Daniel, we hope that answers your question. So thanks for that, Greg. Now, Greg, another just a reminder, our attendees. No, so tell us more about our ongoing series of talks. Now, when is the next one, and what sort of topics are we tackling for our future talks?
Right now, we're still planning on what topics we will discuss, but I think we will probably get into valuation of shares, which will help investors assess how much a share is worth and whether you could earn a return when you buy that certain stock from the market. And you would also be able to know if it's more expensive compared to other stocks that you can buy as an alternative. So I think that's a very useful topic when you're investing.
Okay.
And
Now,
that's
if
probably a short seminar.
that's going to be the next topic for our webinars series. Now,
Sorry.
another question from Carlos coming in. Should we be concerned about the interest coverage ratio?
Yes. But then the interest coverage ratio again needs to be compared to an industry average, or it would also depend on the business model of a company. So some conglomerates would not look good in an interest coverage ratio since, for example, they have a consolidated subsidiary that has a lot of debt, but then the parent doesn't really have a lot of debt. So it varies depending on the company and the level for which you are would be concerned. I think if it's less than 10, I think 10 is a good benchmark, or 5. I think 5 is. I think if it's less than 5,
Should be okay.
you should be a bit concerned.
All right. Okay. Now, another one. Well, thanks, Carlos. Thanks for that question. We hope that Greg answered that. Now, Anthony Naman was asking, what's the difference between free cash flow for firm, FCFF, and free cash flow for equity, FCFFFE? Now, so siguro just to refresh everybody down, so he sort of forgot the difference though.
Free cash flow to the firm is cash flow available to both debt holders and equity holders. And then free cash flow to equity is just the cash flow after only available to equity investors. So free cash flow to the firm is a broader measure compared to free cash flow to equity. And free cash flow to equity, well, either of the two cash flows are used to value shares of the firm. So you could choose. In this webinar, we only highlighted free cash flow as a broad measure, and this is closer to free cash flow of the firm, since this is just operating income less property, plant, and equipment or capital expenditures.
Okay, so Anthony, we hope that answers your question. So another one came in. So will you be providing notes or the topics taken from tonight's talk? No, will these be available to our attendees?
Yes, we will be sending notes to the attendees who finish the webinar.
Okay, so again, to clarify, for all the attendees, we'll be sending these files over for their own personal review. Is that correct?
Yes, we will be emailing these
via email. Okay. Now, if they wanted to get in touch with you, I don't know, for further questions, or how can they get a hold of you, Greg?
You can call me at our office. My direct line is 898-7584 if you have questions related to investments. And then you can also email me, grilag@abcapital.com.ph. And
once again, please, that's
grilag@abcapital.com.ph.
Okay, and on the website, naman, you have your numbers there, so they can just look for you. Yes. Is that right?
Yes, you could also just call the office.
Okay, so so if there are no further questions, ladies and gentlemen, we're just about to wrap up our webinar for the evening. So Greg, any final words? Anything else you'd like to leave our attendees? Anything else?
Just like to say thank you to all those who participated in the webinar.
Okay. Now Greg will. Oh,
and I hope you learned
sorry. Please.
I hope the audience learned a lot. So.
Yes, we're hoping to actually have more of these in the future as well. So Greg will type his info in the chat box, and we'll send it out to everybody. So if you have any questions further down the road, you can just ask him. Okay. So We'll send it also out to you guys. So, okay. So, ladies and gentlemen, thank you so much for attending tonight's talk on financial analysis for equities. This has been brought to us by AB Capital Research. And again, you can go to the website and get in touch with us, specifically for Greg or anybody else from the team for any of your concerns. We'll be more than happy to help you guys out. So, and also the guys of eLearning Edge, we do have a bunch of other topics lined up for webinar series. So again, please do visit the website and get in touch with the team. Ask about all these other great talks that we have lined up for the future. And of course, don't forget to check out their Certified Digital Marketer program as well. Okay, so everybody, thank you so much for joining us this evening, and we hope to see you again soon. I guess that's it. So again, this is Renzi, your moderator for the evening, and on behalf of everybody from eLearning Edge and AB Capital Research and Investments, thank you so much. Have a good evening. Bye-bye.